Traders. In today's video, we will delve deeply into the world of price action trading, which is better than price action indicators. By the end of this session, we will unveil the ultimate price action strategy that you need to know in order to execute profitable trades in the market. Let's begin by understanding the fundamentals of price action trading. So, if you don't know, price action helps us identify when the market might reverse and when pullbacks might end. Many traders, including institutional ones, rely on numerous indicators to predict future price movements for their long or short trades. However, many of these indicators are lagging and based on past price movements, which can lead traders to lose capital as the price doesn't always follow previous patterns. These lagging indicators also result in late entry signals, preventing traders from buying at lower prices. To avoid this, price action helps in accurately predicting future price movements, allowing for significant profits. Before we delve deeper into the strategy, let's cover some basics: break of structure, market structure shift, multi-timeframe analysis, and support and resistance zones. So, let's briefly understand these basics for the sake of beginners. Let's start by understanding 1. Break of structure. A break of structure can be bullish or bearish. Bullish break of structure occurs when the market breaks its recent higher high in an uptrend, indicating a continuation of the bullish trend. Bearish break of structure occurs when the market breaks its recent lower low in a downtrend, indicating a continuation of the bearish trend. Now let's move to our next concept. 2. Shift in market structure, change of character. Market structure shifts can also be bullish or bearish. Bullish shift in market structure or change of character happens when the market breaks a lower high to the upside, suggesting buyers have entered the market and a reversal may be near. Conversely, bearish shift in market structure or change of character happens when the market breaks a higher low to the downside, indicating sellers have entered and a potential reversal. However, a market structure shift alone doesn't confirm a reversal. Additional confirmations are needed, which we'll discuss in this video. Now let's move to our third concept, which is multi-timeframe analysis. This involves analyzing a currency pair's chart across different time frames, monthly, weekly, daily, hourly, to understand the overall market trend. This analysis helps determine optimal buying and selling points and avoids traps set by smart money. Traders use this method to set buy or sell limit orders, respecting higher time frame points of interest for profitable trades. Now let's move to our next concept. For support and resistance zones. Support and resistance zones are critical areas in the financial markets where significant buying and selling activity occurs. These zones cause the market to move up or down upon reaching them. For a support or resistance zone to be considered valid, the market must react to it at least twice. These zones are often established to accumulate counter orders by institutional traders, also known as smart money. For example, if smart money aims to buy a currency pair but finds insufficient sellers in the market, they will first create a resistance zone. Once this zone is respected by the market twice, retail traders and smaller institutions typically set their sell limit orders at this resistance level. With more sellers now available, smart money can purchase the currency pair at the desired level, enabling them to earn substantial profits. Conversely, when smart money wants to sell but there aren't enough buyers, they create a support zone. This attracts buy limit orders from retail traders and smaller institutions once the zone is respected multiple times. This influx of buyers allows smart money to execute their sell orders effectively. Therefore, it's crucial not to place buy or sell limit orders without considering the overall market trend on a higher time frame. This broader view helps ensure that your trades align with the actions of institutional traders and market dynamics. Now let's move to our next concept. 5. Breakouts and fake breakouts. A breakout occurs when the price breaks a level of support, resistance, supply, demand, or order blocks. However, breakouts can be fake, that's why you need to learn price action. Smart money often employs a tactic known as a fake breakout to set a trap for market participants such as retail traders and small institutions. This strategy is designed to gather the necessary counter orders to fulfill their own buy or sell orders. Let's have an example of a fake breakout. Here we have the Euro-USD chart on the 1-hour time frame. Initially, we observe the market making a series of higher highs and higher lows, indicating that it is in a bullish phase. However, after this bullish trend, the market transitions into a consolidation phase. During this phase, the market respects a specific zone twice, establishing this area as a support zone. Recognizing this, retail traders would likely set their buy limit orders at this support zone, anticipating a bounce. As the market approaches the support zone, it dips slightly below this level. This movement can trigger breakout traders to initiate short orders, expecting a further decline. However, the market then reverses and moves upwards, causing these breakout traders' stop-loss orders to be hit. This scenario raises a crucial question: how can traders avoid falling into a fake breakout trap? To address this, we need to analyze the candlesticks formed near the support zone. Initially, the market forms significant bearish candles, indicating that sellers still control the market. Upon reaching the support zone, another bearish candle forms, reinforcing this seller dominance. However, the situation changes when the market prints a large bullish candle with a big body, signaling increased buying activity. Despite this, it is premature to confirm a reversal based on a single bullish candle. Confirmation comes when the market forms another bullish candle with a big body. Once this second bullish candle appears, we can confidently take a buy position from this point, aiming for a target at the identified resistance zone. Let's explore another example of a fake breakout, this time on the pound sterling to US dollar chart on the 1-hour time frame. In this chart, we see the market forming a resistance zone at a certain level. Traders would typically wait for the market to reach this resistance zone for the third time to initiate a short trade. As the market approaches this resistance zone, it temporarily moves above it. This movement causes traders who had placed their sell limit orders at the resistance zone to be stopped out of their positions. Following this brief breakout, the market reverses and moves downward. You might wonder why the market reversed from this higher point instead of the initial resistance zone. The explanation lies in the concept of supply zones. The market had established a supply zone above the resistance zone, which is a level where selling pressure is significant. This supply zone attracted sellers, leading to the market reversal from this higher point rather than the original resistance zone. Understanding the difference between resistance and supply zones can help traders anticipate such fake breakouts and adjust their strategies accordingly. By recognizing these subtle market dynamics, traders can better position themselves to avoid traps and capitalize on market movements. Let's now learn about real breakouts. For a real breakout, wait for the market to close below a support zone before initiating a short trade. This confirmation helps maximize profits by following the trend. Let's have an example of a real breakout. In this example, we observe the market forming a support zone. Initially, the market dips below this support level, then returns to test this zone again. At this point, there are two possible scenarios: the market is either retesting the support zone, or a fake breakout has occurred. When the market behaves this way, it is crucial to wait for confirmation of a genuine breakout before entering a buy or sell position. Confirmation is necessary to distinguish between a real breakout and a fake one, which can be designed to trigger counterorders from market participants. To confirm a real breakout, we need to see the market move below the support level and close below it. This closure would indicate a genuine breakdown, allowing us to confidently initiate a short trade. In this case, the market moves below the support zone and closes there, signaling a valid breakout. We would then enter a short position at this point. Identifying real breakouts on the chart is essential for maximizing profits. For instance, a significant bearish candle formed at this level indicates that sellers have taken control of the market, confirming strong selling momentum. Therefore, we align our trade with the trend, which is a short position in this scenario. Now that we have learned about breakouts, let's move on to a strategy that can help you make profitable trades in the market. This strategy involves using Fibonacci retracement along with price action. Let's understand this with an example. Initially, we see the market making lower highs and lower lows. However, after a certain point, the market starts to reverse, creating higher highs and higher lows. Once we identify the first higher high, we plot the Fibonacci retracement tool to determine optimal entry points during pullbacks, which can help us maximize our profits. In this example, the market pulls back to the 81% Fibonacci level. However, simply reaching this level isn't enough to initiate a long position. To confirm that the pullback has ended, we need to look for rejection candles followed by bullish momentum candles. In this scenario, we observe rejection candles forming, followed by bullish momentum candles. This confirms that the market is ready to move higher, and we can enter a long position at this point. For this trade, we set a risk-to-reward ratio of 3-to-1. As you can see, using this strategy, we were able to make significant profits. I hope you found this video informative and useful. See you next time.